साफ भी सेफ भी।
You're entering CNBC-TV18's Fire Safe Studio, powered by Century Ply, now with firewall technology.
You're with us here on a fresh new edition of Trading Hour. I'm Prashant. With me, my colleague Rima. The market is up and about. We're up 123 points right now. 14,776 is where we stand. I mean, the daily case additions in terms of COVID is the highest anywhere in the world. But the market, as some have said, is looking right through it for now. I mean, it is looking beyond this medical emergency that we have on our hands, which is dire. But that is what the market is doing. For the week, by the way, I mean, from last Friday's close, and this is still midweek so far, the Nifty is already up 3%. So this is quite incredible. Almost 1% on an average each on 3 days that we've had so far this week. So that's where we stand. The bank Nifty is doing pretty well as well. It's up 1%. I think numbers from large banks and NBFCs, etc., have helped sentiment in that space after ICICI over last weekend reported a good set of numbers. Rima, hi, morning.
Hi Prashant, morning. And we've seen the markets very resilient for the last 3 trading sessions. This week itself, the Nifty has seen a gain of close to about 3% and today we're now approaching that 14,800 mark. But the big question is, when will this second lethal wave of COVID peak out? And here I was reading the CLSA note which said that they're drawing parallels from 12 other nations where we've seen a second wave already. And going by that, as well as some of the other internal parameters, they believe that for Maharashtra, we could see peak infections by mid-May and June for the rest of India, and that along with some pickup in the pace of vaccination and comforting management commentary in this ongoing earnings season should allay investor concerns, and that seems to be the playbook that the markets are looking at going by the market reaction. But let's talk about let's invite the big guest that we've lined up for you today. We've got Samiran Chakraborty of Citi who now joins in. Samiran, morning, and thanks so much for joining in. I was reading the note that you put out earlier, and I wanted to understand from you what, according to you, is going to be the economic hit to India in this ongoing second wave, because this time around what is different is that parts of the manufacturing sector are open, agriculture is allowed to be open, so those pockets could be resilient. So what is the overall hit to the economy that we're staring at?
Thanks, Rima. Thanks, Prashant. So the way we are looking at it right now is that the high-frequency indicators that we track, they have started declining a bit from mid-April. And we are now back to where we were sometime around October of last year, if I look at these high-frequency indicators. So that slowing down is partly because of the diverse restrictions being imposed by different states on different kinds of activities, but maybe also because of the fear factor that the consumers might be facing now in imposing voluntary restraints on their own consumption, own activities because of the ferocity of the second wave. So both the physical restrictions as well as the psychological restrictions are probably combining into this drop in growth. But we also see some mitigating factors. This time around, we are much better prepared compared to the first wave with the whole supply chain, e-commerce, work from home environment. We know that in times like this, the formal sector benefits at the cost of the informal sector. So that's also helping on the margin. And we see a pent-up demand coming in the latter part when the waves subside. So taking everything into consideration, we have brought down our GDP growth forecast by 50 basis points from 12.5% to 12%. And we have highlighted another 50 basis point downside risk if this persists a little while longer beyond the first quarter impact. At this moment, we are only looking at the impact to be contained in the first quarter. But if it spreads to the second quarter, we might need sharper GDP downgrades.
Samir and hi, morning. So FY22 GDP estimates brought down by 50 basis points to 12%, and you're highlighting another 50 basis points risk, right? This is FY22.
Yes.
Right. Samir, you said the industry is much better prepared, and also I think the fact is that there is no nationwide complete lockdown like what we saw in March last year, and these are more sort of statewide restrictions, equally disruptive maybe, but it's not national in scope and scale so far. You said you will wait to see how severe the intensity of this wave, how long it lasts, etc. But what is your own sense? I mean, another 50 basis point will do at this point in time. I mean, have you modeled anything around this?
So if you look at how to interpret this 12% year-over-year GDP growth number, the fact is that it's distorted significantly by the base effect. So one way to take out this whole base effect issue is to look at the quarter-over-quarter seasonally adjusted annualized growth rate. That will tell you how much momentum we are assuming in our growth. So if you look at this 12% number, that's assuming a 2.9% annualized growth in FY22, which is less than half of what we probably would have normally assumed a 6% growth in a year. So that gives you the perspective that even at 12% year-over-year, I'm not actually expecting the economy to come back to normalcy in some sense, to run below potential for almost a full year. So this is our challenge, that every time we have this urge to cut our GDP growth forecast based on what is happening on the virus front. But we have to keep in mind that the base effect is so strong that the year-over-year numbers will look high regardless of how the virus situation is. On the virus front, I guess economists should be refraining from forecasting where the second wave would peak. That's the epidemiologist's domain, and let them handle it. But the good news that we are seeing is that the growth rate in active cases and the growth rate in new confirmed cases, those seem to be tapering off. And once that happens, then we are approaching towards the peak. But it's also a function of our testing capacity. If we are unable to expand our testing capacity, then the drop from the peak might not be also as sharp as we would normally expect. But still, in our current projections, we are not expecting the growth impact of the pandemic, the second wave, to last beyond the first quarter.
Okay, Samir, what are the current projections on the impact on the rural economy?
So the virus is starting to spread fast into the rural economy as well. So our estimation of data from rural district versus urban districts, it suggests that now almost 40% of the cases are coming from rural districts. In the first wave, this increased to as high as 50%. So compared to that, it is lower now. But in absolute terms, the rural districts have now more than 1 million active cases. That's more than double that of what was there in the first wave. So just the sheer size of active cases in the rural districts, and probably lack of medical infrastructure in those places, mean that the macro impact, the growth impact on rural demand could also start showing up. In fact, in some of our high frequency indicators, we have started seeing that already, even on the rural demand front. In fact, rural consumption sentiment is already down. The key question is that in the first wave, the rural demand got supported also because of a large amount of fiscal stimulus, and to some extent, the large migration that happened into rural areas helped support the rural demand. How much of these two factors will be present in the second wave, in the latter part of the second wave, we would, based on that, we'll have to see whether this declining rural demand is sustained over a longer period of time or not.
Samiran, do you expect, I mean, so for example, we have industry bodies from the finance sector making representations to the RBI to provide some sort of, dispensation for restructuring of loans, etc. I mean, would the government and the RBI have to step in again, or you think the measures which are in place have been and are adequate?
So the good news is that the large part of the stimulus of last year are still within the system. We have not withdrawn too much of that stimulus. So that's the glass half full story. The glass half empty story is that because that stimulus is already there, the ability to do more stimulus will be relatively limited. Particularly in this question about forbearance, moratorium, etc. I think the additional peculiarities that we might have to deal with is that in the first wave, willy-nilly, the moratorium benefits were applicable to everyone, finally, after the Supreme Court judgment. So one of the questions would be the equity of that, equity principle of that kind of a scheme, that whether it should be more targeted or not. Similar challenge this time around would be that, as Rima was mentioning, that this time the restrictions are not uniform across the country. So the growth impact of the lockdowns will not also be uniform. But if you have a moratorium which is uniform for everyone, would it be benefiting a few more at the cost of others? So that sort of equity principle, how you bake into these assumptions would be important. But the most important part would be to see how the high frequency indicators are behaving. And based on that, the authorities will have to take a call on whether it's the right time to announce the next set of stimulus or not.
Fair point. Samiran, getting back to the GDP hit, so the loss to the Indian economy is going to be between 50 to 100 basis points, going by your current assessment. Can this be made up? Can it in any way push up growth expectations for FY23 when we talk about pent-up demand?
Typically we have seen that the pent-up demand hits much faster. So if you recall, in the first wave, almost as soon as the first wave was peaking around August, September, we saw that pent-up demand came back quite strongly during the festive season within the next 2-3 months. Now, there are 2-3 aspects of this pent-up demand. One aspect is a forced savings angle, that you are unable to spend for a couple of months while you have the income. So that's forced savings gives you the power to spend a bit more. The second aspect is that just because of physical restrictions, you could not visit a store, auto dealerships are closed, you can't buy a car. So once those restrictions are removed, you just go ahead and buy. And the third pent-up demand component, which was pretty strong in the first wave, might not be present so much in the second wave, is the element where everyone was getting adjusted to this new work environment, new home environment by buying different sorts of things. One additional laptop, one additional television, one kitchen set, etc., etc. That part of pent-up demand, that strength of that pent-up demand in the first wave was probably much stronger, might not be present so much in the second wave because that's already done and dusted. So that's why we are thinking that the extent of this pent-up demand in the second wave would be relatively smaller compared to the first wave, and it will probably be done within 1 or 2 quarters and not spill over as much into FY23.
Samiran, this is a broader question tied into capital flows into emerging markets like India. You know, some believe that the EM-DM growth differential, the gap is essentially starting to turn negative now. Growth around the world is expected to be led sharply higher by the US. There is also the issue of rising case counts and slower pace of vaccination in emerging markets like India. There is also, policy support, which seems, the message in the Western world is lower for longer. In a lot of emerging markets, take China, for example, there is already a sense that maybe we should start to pull back on some of what we announced last year. What is your own assessment and the global folks at Citi are making of this, and whether this will be a crucial factor in determining returns between emerging markets like India and the developed world.
So even in the developed world, I don't think we can paint it in the same brush. There's clearly US exceptionalism going on, that the expectation of US growth getting stronger and stronger is very high. I don't think we can say the same thing about Europe. But the key question is that generally when China used to drive global growth, the supply chains linked to China in rest of the EM used to benefit out of it, and their trade through their trade channel. You would have seen those countries growing faster. If US is growing strongly, which of the countries in the US supply chain would benefit from that move is going to be crucial. Would US be as much dependent on the external supply chains, or most of the growth will be more domestic focused? That's another open question. So in a sense, the pivot for world growth, if it is shifting from China export-led model into a US domestic growth-led model, then there could be very differential impact from the EM perspective. And from China, I think the issue is that China oscillates between a high growth strategy and a strategy to achieve financial stability. I think this is the year where we believe that in the latter part of the year, China will try to push their financial stability strategy once more, because they've come out of the pandemic much better from a growth perspective. So when that happens, then China growth stalls for a bit. But if the overall view seems to be that US growth and linked to US growth, whichever EMs are there, they will fare much better.
Okay, so that relationship will hold. Thank you very much, Samiran. Pleasure speaking with you, and great sort of getting that perspective on a range of issues from you. So Citi has lowered their GDP forecast for FY22 by 50 basis points, and Samiran is saying that there is a risk that they may be a hit of another 50 basis points sometime down the year, depending on how the COVID second wave progresses, the impact it continues to have on the economy. I think it's time for a quick break here. The stock market here and now is looking buoyant. It's up 122 points, as I pointed out. And for now, it looks like it's looking through the medical mess we have on our hands. 14,775. Bank Nifty still got about 1% in gains. We are back on the other side.